Welcome to Talk Tickers. Today we're going to strip the paint off the modern stock market. We want to look at the machinery that's really churning underneath. We're doing a deep dive into the hidden engine that has powered this explosion of retail trading over the last decade. It's a mechanism that's made buying stocks, well, easier than ordering a pizza. But it's also sparked a massive global debate about market fairness. We're talking about payment for order flow, or PFOF.
It's one of those terms that sounds incredibly bureaucratic, doesn't it? Like something you'd find buried in the fine print of a user agreement and, immediately skip over.
Totally.
But effectively, PFOF is the lifeblood of the entire zero commission economy. It's the reason you can trade for free.
It really is. And the premise we're starting with today is something most of us we just accept it as reality now. You open your phone, you open a brokerage app, you see a stock, let's say Apple or Tesla, you press a button and you own it. The commission fee is zero. It feels completely free.
It feels free. But there's that old saying from the tech world that applies perfectly here. If you aren't paying for the product, you are the product.
And that is the thesis we are unpacking today. Because while those, $10 commissions we used to pay are gone, the brokerage firms are definitely not running charities. They are generating billions of dollars by selling your orders. Literally selling the right to execute your trade to high-speed trading firms.
And that changes the whole dynamic. It really does. It raises all these questions about execution quality, about conflicts of interest, and about the very structure of the market. So our roadmap for today is first to break down exactly how this mechanism works, the actual plumbing of it. Then we're going to look at why the industry has shifted so hard toward options trading. That's a huge revenue driver. And then the whole controversy around best execution. And finally, this new frontier of monetization, which is securities lending.
Okay, so let's get right into the nuts and bolts then. We hear the term payment for order flow tossed around a lot, especially when there's a market frenzy or a meme stock rally. But let's define it properly. What is it fundamentally?
Simply put, payment for order flow is the compensation. It's the money a brokerage firm receives for routing your trade to a specific market maker, so a wholesaler, rather than sending it directly to a public stock exchange like the NYSE or the NASDAQ.
Okay, let's pause there because I think this is where the average investor's mental model it breaks down. I click buy on my app. I assume my order goes to the stock exchange, matches with the seller, and we're done. But you're saying it takes a detour?
It's more than a detour. For most retail orders, it's a completely different destination. The public exchange is, let's say, a town square where everyone is shouting prices. But your broker has a deal with the wholesaler firms like Citadel Securities or Virtue. These are massive high-tech trading firms. The broker sends your order directly to them into what's basically a private room.
And why does the wholesaler want my order? I mean, I'm buying 10 shares. I'm a nobody. Why do they care about my tiny trade?
Well, the wholesaler executes the trade, often right out of their own inventory of stocks. They become the counterparty. And for that privilege, for handling that order, they pay the broker a small fee.
That's the part that feels so counterintuitive. Why would they pay to handle my trade? Usually, if I want a service, I'm the one who pays. Here, they're paying to service me.
It all comes down to a concept called uninformed flow. And don't take that personally in market terms. Uninformed just means you aren't trading on, say, inside information or some sophisticated algorithm.
No, I'm buying because I like the company's new phone, not because I know the CEO is resigning in 10 minutes.
Exactly.
Yeah.
For a market maker, you are safe to trade against. If a huge hedge fund wants to buy a massive block of stock, they probably know something, right? The price might move against the market maker. That's called toxic flow.
But retail flow is random.
Retail flow is generally random. It's smaller in size. And it's not connected to those short-term price moves. So wholesalers are willing to pay for it because it lowers their risk. They can capture the spread, that difference between the buy and sell price, without getting run over.
And when we say they pay the broker a fee, we're talking about fractions of a penny per share, right? Tiny amounts.
Fractions of a penny, usually millitenths of a cent. But when you aggregate that over millions and millions of trades a day, the numbers get staggering. I mean, to give you a sense of scale, in 2020 alone, the top retail brokerages generated roughly $2.6 billion just from PFOF.
Wow. So that's a multi-billion-dollar industry built on just shaving fractions of a penny off millions of transactions.
It is. And it explains how these brokerages can afford to be these slick tech companies, with great apps and 24/7 support, all with zero commissions. The revenue stream just shifted from the front end, where you pay a fee, to the back end, where the wholesaler pays your broker.
Okay, I want to put this into historical context for a second. This didn't just happen overnight. I remember paying $7, even $10 a trade not that long ago. If you were an active trader, commissions were a huge drag.
It feels like ancient history now, but yeah. The shift really picked up speed around 2013 with the launch of Robinhood. They pioneered that zero commission model for mobile, banking entirely on PFOF. It basically forced the hand of the whole industry. By 2019, the big guys, Schwab, TD Ameritrade, E-Trade, they all had to give in. They dropped commissions to stay competitive, and PFOF became the industry standard.
But PFOF itself isn't new, right? Robinhood didn't invent this.
No, not at all. The practice goes back to the 1980s. It's been part of the market's plumbing for a long time. What changed was the scale, the reliance on it as the primary revenue driver for these apps. And it's really important to note this is largely a US-centric phenomenon.
That's a key point. We often just assume markets work the same everywhere. You know, if I go to London or Toronto, the structure's got to be pretty similar.
Far from it, at least on PFOF. While it's standard practice here, there's this massive global divergence. The United Kingdom and Canada, they effectively prohibit it, and the European Union has moved to phase out and ban PFOF entirely by 2026.
That is a huge contrast. Why is the EU taking such a hard line on this? If it keeps trading free for the little guy, why would you ban it?
The European regulators, they see it as fundamentally incompatible with the client's best interest. Their argument is structural. A broker can't serve two masters. If a broker is being paid by a wholesaler to send them orders, can they really guarantee they're finding the absolute best price for you, the customer? The EU says no. They believe the conflict of interest is just. It's insurmountable.
So in Europe, you might pay a small commission, but your trade goes to a public exchange where it's all transparent.
Generally, yes. They prioritize that transparency, the integrity of how prices are discovered, over the free user experience.
Which brings us to the stress test. The system works fine when things are calm, but we saw what happened in January 2021 with the whole meme stock thing, GameStop, AMC. What did that show us about PFOF's fragility?
That was a critical moment. During that insane volatility, the wholesalers, who usually love retail flow because it's safe, they suddenly got very, very nervous. The risk just became too high. The flow wasn't uninformed anymore. It was a herd. So off-exchange trading, that internalization, it actually dropped because wholesalers didn't want to get stuck holding the bag.
And for the investor, that meant costs went up, even with zero commissions.
Correct. And this is where we have to talk about the spread, the bid-ask spread, the gap between what you can sell for and what you have to buy for. It widened significantly. We saw spreads on those stocks jump to 50 times larger than normal. So maybe you didn't pay a $5 commission, but you might have paid $20 or $30 extra just in the spread because the market execution quality fell apart.
Let's unpack the economics of the spread a bit more. This is part one of our deep dive. We know the wholesaler pays for the order, but how do they justify it to regulators? What's the official defense?
The defense is a concept called price improvement.
Okay, walk me through that.
Let's look at the penny spread. On an exchange like the NYSE, a stock might be listed with a buy price of $10 and a sell price of $10.01. That penny is usually the smallest gap, the minimum spread.
So if I go to the public market, I have to pay $10.01.
Right. But wholesalers aren't bound by that penny increment when they internalize a trade. They can trade in sub-pennies. So a wholesaler might see your buy order and say, I'll sell it to you for $10.09.
So I save a tenth of a cent.
You save a tiny fraction. Yeah. If you buy 100 shares, maybe you save 10 cents.
That really doesn't sound like much.
It isn't, individually. But the industry argument is that it adds up. Think of it like splitting a pie. The profit from that spread gets divided three ways. You, the customer, get a sliver in price improvement. The broker gets a slice in the PFOF fee, and the wholesaler keeps the rest.
So the argument is, look, everyone wins. The customer gets a slightly better price in the exchange, the broker gets paid, and the wholesaler makes a profit.
That's the billboard version, yeah. But there's a pretty substantial counter-argument. There's data out there suggesting the hidden costs of this whole system could be up to $34 billion a year.
Wait, how do you get to $34 billion in costs if I'm getting price improvement?
The argument is that the benchmark itself is flawed. If all these retail orders are being siphoned off to private wholesalers, the public exchange becomes less liquid. The official price on the exchange might be artificially wide because it's not seeing all the activity. So the wholesaler improves on a bad price, gives you a tiny crumb, and keeps the rest of the profit for themselves.
It's the boiling frog situation. You notice a commission fee because it's a line item. You don't notice the execution price because you have nothing to compare it to in real time.
Precisely. If you save 5 cents on the share price, but a truly competitive auction could have saved you 10 cents, well, you lost money. But you'll never see that alternative reality.
So stocks are a game of pennies, but the research shows that stocks aren't even the main event anymore. Which brings us to part 2, the options trap.
This is where the numbers get really wild. If PFOF on stocks is a nice, reliable stream, PFOF on options is a gold mine.
I was looking at the numbers. Something like 65% of PFOF revenue doesn't come from stocks. It comes from options.
It's a massive skew. It implies that free stock trading is almost a loss leader. It gets you in the door so they can monetize you on options.
Why is that? What makes an option trade so much more profitable for them?
It's the spread again. The airport currency analogy is perfect here. You go to a foreign airport, you want to swap dollars for euros, and the kiosk has a big sign, no commission.
Right, but you know you're getting ripped off on the exchange rate.
Exactly. The spread between the buy and sell rate is huge. You lose 10% just on the conversion. Options are similar. A liquid stock like Apple has a penny spread. But options, especially weekly ones, are really illiquid. The average bid-ask spread on some of those can be around 12% or even more.
12%, that is enormous.
It is. And because that spread is so wide, let's say 50 cents or $1 wide, the wholesaler makes a much bigger profit per trade. And because they're making more, they can afford to kick back a much larger fee to the broker.
Can you give me a concrete comparison?
Sure. For a normal stock trade, say 100 shares, the broker might get 20 or 30 cents in PFOF. For a single options contract, they might get $4, maybe more.
That creates a massive conflict of interest for the app itself, doesn't it? If I'm a brokerage app, I make 10 or 20 times more money if you trade an option versus a stock.
And that forces you to look at the user interface. When you see confetti animations or one-click options trading or these trending lists filled with derivatives, is that designed really for your financial health? Or is it optimized to funnel you into the high-margin product?
It pushes you further out on the risk curve. Most people get buying a share of a company. Far fewer understand the time decay of a weekly call option.
And yet, that's where the revenue is. It's a volume game on high-risk assets.
Okay, so we've got stocks, we've got options, but the neo-brokers are evolving. PFOF is under scrutiny, regulations might tighten up, so they need a new revenue stream. This brings us to part 3, securities lending.
This is the next frontier. You've probably seen the notifications pop up on your phone recently. Turn on stock lending, earn passive income.
I have seen this. It's pitched as get paid while you sleep. Who says no to that?
It sounds great, but you have to understand the mechanism. The broker is taking the stocks that are just sitting in your account stocks you paid for and lending them out. And who wants to borrow stocks? Typically, it's short sellers.
So hedge funds who are betting against the very stock I own.
Yes. You are literally facilitating the short side of the market for the assets you're long on. You're supplying the ammunition to people betting on your stock's decline.
That is incredibly ironic. I'm earning a 4% yield to help someone drive the price of my own asset down.
Well, the market impact is debatable, but the irony is definitely real. But beyond that, there are real structural risks. When you lend your shares, you shift from being an owner to being a creditor.
What does that mean for me, practically?
First, you lose your voting rights. If there's a shareholder vote while your shares are on loan, you have no say. The borrower gets the vote. If you care about corporate governance, that matters.
And what about safety?
That's the bigger issue. There's counterparty risk. If the borrower collapses, you're exposed. And crucially, SIPC insurance, that's the government-mandated protection, up to $500,000 if your broker goes bust. It doesn't always apply to shares that are out on loan.
Whoa. That is a detail I guarantee no one reads in the terms and conditions.
It gets much murkier. The cash collateral is usually protected, but the securities themselves are no longer in your possession. It introduces this layer of risk that's being marketed as free money.
The common thread here seems to be financial engineering. The retail user takes on a subtle, invisible risk execution quality, options leverage, counterparty risk, and the platform just monetizes that at scale.
Passive income is the marketing hook. Collateralized lending to facilitate short selling is the reality.
I want to clear up one specific myth before we move on. You spend any time on Reddit or financial Twitter, you hear constantly about front running. People think the wholesaler sees their order and jumps in front of it. Is that what's happening?
Strictly speaking, no. That would be illegal. And frankly, the big market makers like Citadel don't need to do that to make money.
How do they operate then?
They're generally delta neutral. meaning they don't care if the stock goes up or down. They aren't betting against you. They're just trying to capture the spread. They want to buy from you at the bid and sell to someone else the ask thousands of times a second. They're mechanics, not gamblers.
So they aren't evil villains stroking a cat betting you'll lose.
No, they're neutral efficiency engines. The conflict isn't front-running. The conflict is routing. The broker is legally bound to seek best execution, but they're also incentivized to route to the wholesaler who pays them the most PFOF.
And can you really serve two masters? That's the whole gray area.
Exactly. It's not a conspiracy of theft. It's a conspiracy of incentives. If wholesaler A gives better prices but pays the broker less, and wholesaler B gives worse prices but pays the broker more, where does your order go?
That distinction is so crucial. It's not about them stealing your trade. It's about them skimming efficiency off the top of the market.
Precisely.
This brings us to the core of the issue then. We've covered the mechanism, the options trap, the lending risks. But for you, the listener, sitting there with your portfolio, what is the one question you need to be asking?
The one question is this. Am I trading in a liquid market where the free commission is a bargain?
Or am I trading illiquid assets, like options, where the spread is costing me more than a commission ever would?
Explain why that distinction matters so much one last time.
Because free trading is only a good deal if the bid-ask spread is tight. If you're trading Apple stock, the spread is a penny. PFOF probably saves you money compared to a $10 commission. But if you're trading complex options where the spread is 50 cents wide, you're bleeding money. That hidden cost of the spread creates this huge hurdle you have to overcome just to break even.
That is a powerful takeaway. We always look at the sticker price and just ignore the handling fees. You have to do the math on the total cost.
Always. Look at the bid, look at the ask, calculate the difference. That is the true cost of your trade, whether the commission says 0 or not. Okay, so to recap our deep dive today. Payment for order flow is the engine that allows for zero commission trading, but it comes with strings attached. Your orders are routed to private wholesalers, not public exchanges, because your flow is considered safe and valuable.
And while that system might give you slight price improvement on boring liquid stocks, the real profit center has shifted. It's moved to options trading, where those wider spreads allow for massive kickbacks to brokers, creating a perverse incentive to gamify risk.
And looking ahead, securities lending is the new revenue lever. It effectively turns investors into creditors and facilitates short selling against their own holdings, often without them fully grasping the risks.
It's a complex ecosystem. And while PFOF is legal and standard here in the US, we have to remember the rest of the world isn't so sure. The fact that the EU, the UK, and Canada have all taken hard stances against it, well, it suggests the debate on fairness is far from over.
It makes you wonder if the US will eventually catch up, or if we're just too far down this path of free trading to ever go back.
That's the multi-billion-dollar question, isn't it? Regulation usually lags behind innovation, but the SEC is certainly looking closer than they used to.
Well, that is where we'll leave it for today. Thank you for listening to Talk Tickers. We hope this look under the hood of your trading app helps you navigate the markets with a bit more clarity. And maybe check that bid-ask spread a little closer next time.
Keep asking questions.
See you next time.